We are covering these 8 top actively traded stocks that are bullish today. While watching price actions, let us inform you our review on Coca-Cola, the beverage giant we all know and love, has been performing pretty solid lately, and it's no surprise why. With its iconic drinks like Coca-Cola, Sprite, and Fanta, plus a whole bunch of other brands like Minute Maid and Powerade, Coca-Cola continues to dominate the global market. The company operates in over 200 countries, and it's a staple in households around the world. Today, Coca-Cola stock is up about 2.6%, and there's a good reason for that. In the first quarter of 2025, they reported a 6% increase in total revenue and a solid 12% boost in organic revenue. On top of that, earnings per share, EPS, jumped 12% and global sales volume was up 2%. That shows Coca-Cola is holding its own despite the ongoing economic challenges, which is always a good sign for investors. But here's the real kicker. Coca-Cola is a dividend king, meaning it's been consistently increasing its dividend for over 60 years. This year, they raised it by 5.2%, making it the 63rd consecutive year of dividend hikes. For income-seeking investors, that's a pretty sweet deal, even with the stock price moving up. Now, some people might think Coca-Cola stock is a bit pricey at the moment, but if you're looking for a stable, income-generating stock that's been through it all and still delivers, this is one to keep an eye on. It's a great choice for long-term investors who want a reliable dividend payout and the security of a major global brand. Our review on KULR. KULR Technology Group Incorporated is making waves in the energy management space with its carbon fiber thermal management technology. Specializing in keeping batteries and electronic systems safe, the company targets a wide range of industries. From aerospace and hypersonic vehicles to electric vehicles and 5G tech, KULR Solutions focus on safety and sustainability, offering products that can prevent thermal runaway in batteries, improve energy storage, and support emerging technologies. However, recently, KULR has come under scrutiny. A report from Grizzly Research has sparked some controversy, with the firm labeling KULR as just a fancy PR machine that's struggling with real business success. Grizzly claims that while KULR touted a record revenue year, the numbers were padded by pulling forward future licensing revenue, money that won't actually be collected until the next few years. They also highlighted declining sales in certain areas, along with concerns about customer retention and the company's overall scalability. The report sent KULR's stock down almost 4% in early trading, though it managed to bounce back slightly, up 2.34% today. The company has ambitious plans, including a significant revenue projection boost for 2025, a potential partnership in robotics and AI, and even investments in Bitcoin. However, critics argue that these moves might just be PR stunts designed to keep the stock afloat, without much solid backing. For investors, it's a mixed bag. KULR has some innovative tech and big plans for the future, but with its stock showing vulnerability to short seller attacks and questions about its financial health, it's definitely one to keep an eye on. If you're considering buying in, it's important to weigh the potential against the risks. Our review on MDLZ. Mondelez International Incorporated has built quite the global snack empire, with everything from Oreo and Ritz to Cadbury and Toblerone under its belt. With a massive portfolio that spans chocolate, biscuits, and snacks, not to mention its presence in gum, cheese, and powdered drinks, Mondelez has a strong grip on the global snack market. The company operates in about 80 countries and has over 140 manufacturing facilities around the world. So, it's no surprise that Mondelez products are in virtually every supermarket and convenience store out there. Recently, Wells Fargo made some waves by keeping an equal weight rating on Mondelez but raising its price target from $64 to $68. This move reflects some confidence in the company's future, though it's still seen as a bit of a neutral play. Mondelez's stock is up 2.68% today, which could signal that investors are feeling optimistic, at least in the short term. With the snack giant continuing to expand its global reach and manage a solid portfolio of brands, it seems like the company's in a pretty stable position. That said, Wells Fargo's cautious stance suggests that there might not be any massive breakout potential in the near term. Mondelez is a solid, reliable company, especially for those looking for a steady performer in the snack and consumer goods sector. But for now, it's more of a hold than a buy for aggressive investors looking for the next big thing. Keep an eye on it, especially as it continues to expand and innovate, but don't expect fireworks unless there's a significant change in market conditions. Our review on JNJ. Johnson & Johnson, a healthcare giant known for everything from prescription medicines to medical devices, is making some noise in the market lately. With its massive footprint across both pharmaceuticals and medical tech, it's a key player in healthcare, serving everything from oncology and immunology to orthopedics and surgery. The company operates through two main segments, innovative medicine and medtech, both of which provide products to hospitals, pharmacies, and healthcare professionals worldwide. Now, here's where things get a bit tricky. On March 31st, 2025, J&J faced a setback in the courtroom. The U.S. Bankruptcy Court shot down a bankruptcy plan from its subsidiary, Red River Talc LLC, which was hoping to settle some of the ongoing legal issues surrounding its talc products. This rejection means J&J will reverse about $7 billion that had been set aside for this issue, which could impact its financial outlook and stir up some concerns among investors. However, despite this hiccup, J&J stock is up nearly 3% today, suggesting that the market isn't overly shaken by this development. In fact, RBC Capital still has an outperform rating on the stock, keeping its price target at $181, which indicates confidence in the company's overall trajectory. So, while this bankruptcy news is definitely a bump in the road, Johnson & Johnson's diverse portfolio and strong market position still seem to be holding steady. Investors are keeping an eye on the long-term potential, especially with the company continuing to lead in both innovative medicines and medical devices. It's one of those moments where you see some short-term turbulence, but with a solid foundation underneath, the stock is holding up just fine. Definitely worth watching as J&J works through this challenge. Our review on FSLR. First Solar Incorporated is making waves in the solar industry, and it's not hard to see why. With its focus on cutting-edge thin-film photovoltaic PV technology, First Solar has built a solid reputation in the renewable energy space. The company primarily sells solar modules, including its popular Series 6 Plus and Series 7 modules, to a wide range of customers from utilities to commercial and industrial clients. These modules convert sunlight into electricity and are an essential part of the growing push toward clean energy. Now, here's where things are getting interesting. While the broader solar sector has been facing some tough times, mainly due to new tariffs hitting solar supplies from Southeast Asia, First Solar has managed to shine through. Despite the broader industry struggles, the company's stock is up nearly 5% today, showing strong resilience in a turbulent market. The tariffs have put pressure on many solar companies that rely heavily on imports from Southeast Asia, leading to increased costs and disruption in supply chains. But First Solar's unique focus on manufacturing its own CDTE, cadmium telluride, thin-film solar panels has positioned it in a more favorable spot. With less reliance on external supply chains, First Solar is less exposed to the global tariff headaches that are affecting many competitors. This is a good reminder of why investors often look for companies with strong, differentiated business models. First Solar's in-house production strategy is clearly paying off, even in the face of broader sector challenges. If the company can continue to deliver strong results amid these headwinds, its stock could keep rising as it captures more of the renewable energy market. Definitely a name to keep an eye on if you're looking at the long-term potential of solar energy. Our review on GSK. GSK p.l.c., one of the heavy hitters in the global biopharma space, is making moves that investors should take notice of. The company is a leader in developing medicines and vaccines in key areas like respiratory diseases, immunology, oncology, HIV, and infectious diseases. From cutting-edge treatments for conditions like lupus and cancer to a diverse vaccine portfolio, GSK has its hands in some important areas of human health. Now, here's why the stock's catching some positive attention today. GSK stock is up over 3% today after Bernstein analyst Florence Cespedes came out with a buy rating on the company. Bernstein set a price target of £22.90, which gives a bit of optimism for GSK's future prospects. This comes at an interesting time because, while the general analyst consensus for GSK has been more neutral with a hold rating, Bernstein's outlook provides a bit of a boost. However, it's not all sunshine. There has been some negative sentiment from corporate insiders recently, with an increase in insiders selling off shares compared to earlier in the year. That's something to keep an eye on, especially for those who like to track insider movements as a potential signal. Still, GSK's fundamentals remain strong, with its broad portfolio of vaccines and medicines addressing major global health issues. If the company can continue to execute on its pipeline, especially with drugs like IDRX-42 aimed at treating gastrointestinal tumors, it could continue to see growth, especially in its specialty medicines. If you're looking at GSK, the stock's performance today is a reflection of its resilience, even amid mixed opinions from analysts. With a strong portfolio and promising pipeline, it's worth keeping an eye on, especially with a higher price target and a solid track record in the industry. Our review on PM. Philip Morris International Incorporated has been a player in the global tobacco game for a long time, with a product portfolio that spans cigarettes and smoke-free options like IQOS, HEETS, and other nicotine products. The company is trying to lead the way in the smoke-free revolution, with heated tobacco products, nicotine vapor, and even wellness-related items like lighters and accessories. With well-known brands such as Marlboro, Chesterfield, and L&M, PMI is a giant in the industry. Today, the stock is up by nearly 4%, and that's largely due to some news coming out of UBS. The analysts there believe that the new tariffs imposed by the U.S. government, like the 10% tariff on imports, should be manageable for tobacco companies like Philip Morris. Sure, tariffs are never ideal, but according to UBS, this won't rock the boat too much for companies that are already used to dealing with international trade dynamics. That's a relief for PMI, considering its global footprint across regions like Europe, Asia, and the Americas. However, it's not all smooth sailing. While the tariff news isn't expected to be a big blow for Philip Morris, the broader economic uncertainty could still affect U.S. consumer spending, which in turn may continue to weigh on domestic cigarette volumes. That could be an ongoing challenge for U.S.-focused brands under the PMI umbrella. But here's the kicker. Despite this potential drag on U.S. sales, the broader tobacco sector remains fairly defensive, and that's likely why Philip Morris is still holding up well compared to other sectors. Tobacco stocks in general are known for being less volatile during uncertain economic times, and that's part of what's keeping the stock buoyed. All in all, PMI is handling the news with resilience. They've got their foot in both the traditional tobacco space and the growing market for smoke-free products. With a solid global presence and a portfolio designed for the future, the stock's up today, and with continued sector stability, it looks like a solid player to keep on your radar. Our review on BTI. British American Tobacco p.l.c. is a major player in the global tobacco and nicotine market, offering everything from traditional cigarettes to smoke-free products like Fuse, Glow, and Velo. The company has a wide-reaching portfolio and is making strides in the smoke-free sector with products like nicotine pouches and tobacco heating devices. Today, BAT stock is up around 4%, and that's partly thanks to a positive outlook despite new U.S. tariffs. The U.S. has slapped a 10% baseline tariff on imports, which had some investors worried about global companies like BAT. However, UBS believes these tariffs will be manageable for BAT, as they're used to navigating international trade challenges. The bigger issue is the potential strain on U.S. consumer spending, which has already impacted cigarette volumes. But the good news for BAT is that the tobacco sector tends to do well in uncertain times, as it's seen as a defensive industry. Even with some challenges in the U.S. market, BAT's broad product range and strong position in the smoke-free market leave it well prepared for the future. Investors seem confident, and today's uptick in stock price reflects that stability. Please subscribe, give the video a like, and watch more from our playlist. Thanks.